Hi, I'm Derek from CoVenture Tax Consulting. From 2024, holders of land that has been zoned by a local authority for residential development or mixed use, including residential development, will be liable for a new tax. The tax is 3% on the market value of the land. In this video, I explain the background to the tax, who is liable, what the exemptions are, and how you may be able to minimize your exposure to it. Residential zoned land tax is a site value tax on the value of land that has been zoned for residential development in its entirety or for mixed use with some residential element to it. The site tax is applied to the undeveloped value of the land. That means the value of the land before any assets have been built on it. The tax will apply from 2024 and is calculated at 3% of the market value of the land. Sites liable to the residential zoned land tax will be valued in February in the first year in which the tax arises. That valuation becomes the benchmark for the first 3 years of the tax, and after that, the cycle repeats with a new valuation being required and that valuation holding for a further 3 years. So in this example, a property is caught by the charging provisions in 2023, and therefore it must be valued in February 2024. The valuation process determines the value to be 2 million, and therefore the liability to tax is €60,000, 2 million at 3%, and this is the figure payable for 24, 25 and 2026. So the valuation is used as a benchmark for liability to tax on a rolling 3-year period. So assuming there's no change in the facts or circumstances, the property will be revalued again in February 2027, and this valuation will be the new benchmark for the purpose of calculating the liability in 27, 28 and 2029. What is interesting is that while we have a benchmark process for a rolling 3-year period, there is no provision in the legislation for recalculating exposure in the event that the property value falls. Every local authority in Ireland has been given the responsibility for preparing a map of sites within its functional area to be targeted with this new tax. Let me show you what I mean. On screen, you can see Dublin City Council's residential zoned land tax maps. So you can go into this and look at the various maps in 2 ways. You can download maps by map set for the different parts of Dublin, or which is probably easier, you just click into their interactive map, which I have just done. So as this map loads, I want to zone in on Drumcondra just for an example. And if I click zoom in here, you can see that I can browse by street. There's Clonliffe Road, there's Distillery Road, and I can see which properties on that street are in the local authority zoning plan. And for example, Holy Cross College here, which is shaded in red, is zoned for mixed use, and other properties around it are zoned yellow for residential use. This process of mapping has been ongoing for a long time, but for tax purposes, local authorities were charged with preparing an initial map by the end of 2022. Individuals who own properties were afforded an opportunity to challenge inclusion in these maps by the 1st of January, and various challenges had to be evaluated and determinations issued by the beginning of April. The plan is to have a final map for tax purposes by November, December 2023, but this is an ongoing process. So once you've established that your property is on a map, well, then you have to look at whether it meets all of the criteria. And if you can defeat one of these criteria, well, then you can avoid the tax. So the first thing to look out for is, are you on a development plan or a local development plan? If you are you zoned primarily or solely for residential use or for a mixture of uses, including residential use? If you're not zoned for residential, well, then you're not caught by the tax. The next thing is, well, can the land be easily developed. So the test for that is whether the land has access or it can be connected to public infrastructure and facilities that would be necessary for the dwellings to be developed. So the type of things you're looking out for is access to roads and footpaths, public lighting, sewer drainage, surface water drainage, and water supply. Even if you have access or can be connected to these things, there must be sufficient capacity available for the development. So if you're caught because you do have access, well then make a determination that as to whether or not the type of access will give you sufficient capacity to develop the site. Finally, you will not be liable to the tax if the site is contaminated. So, for example, if there had been asbestos on the site and there's a process required to decontaminate the site, well, then you won't be liable. And this is because the site can't be easily developed. Another example of how you might be able to avoid it is if the site is a known archaeological or historic site. Well, then you'll be able to avoid the liability to tax for those reasons. Certain types of land and residential land can be excluded from exposure to the tax. The main exclusions apply to land where development has begun on the land, or where maybe there's an appeal outstanding in relation to the inclusion of the land on a local authority map. But aside from those, things that you could look at are the use of the property. If the property is residential and zoned, but it is being used, for example, as a local shop like a Spar, well then it won't be liable to the tax. Land that is required for or is integral to occupation by community or government, transport or energy or telecommunications type facility, well, those types will be excluded from exposure. And likewise, land that cannot be developed by law is excluded, and land that is subject to the Derelict Sites Act, i.e. that has been listed on a derelict site. I would say, however, just be careful, there is a derelict site tax, which is 7% of the annual value of that land. So, don't be looking at that as a way to avoid exposure to this tax. You'll end up paying a lot more. There's a nasty side to this tax, and that is how it interacts with local property tax. Now, if you have a large property, say 1.5 acres in size, you would be forgiven for thinking that you're paying your LPT, therefore, how could you also be liable for this tax? Well, you can be liable, and that is because of how this tax and LPT interact with each other. There's an exclusion for properties that are liable to both, but that exclusion only applies to the house and gardens up to a size of 1 acre. So if you have a house and gardens that exceeds 1 acre, well, you'll pay LPT on the first part, but any excess above that, depending on the zoning and depending on whether you're included on the local authority map, could be liable for the residential zoned land tax too. So to recap, if you have property on hand at the end of 2022, it's on a local authority map, it meets all of the conditions and doesn't qualify for any of the exceptions, you're going to be liable to this tax. Your liability will start in 2024. You'll be required to file your details on Revenue's portal by the end of this year and to obtain a valuation by February 2024. The valuation that you take out will be the benchmark for your exposure in 24, 25 and 26. If you're not liable, but you become liable, either by acquiring a property or there's a change in the planning or change in the criteria, and that happens in 23, for example, the earliest you'll be liable to the tax is 2026. And that is because for new properties or so-called new properties, there's a 3-year derogation. There's one last feature of this tax that I must mention because it's particularly nasty and totally unnecessary in my view. It is that the Revenue Commissioners will publish property and ownership details on their website on an annual basis using the filings that are made by people liable to this tax. This is a gross invasion of privacy and must be contrary to EU law in my view. However, as enacted, this is the requirement and this is what will happen. So I'll be hoping that there will be some pushback or that the legislation will be amended so that the publication details are curtailed or removed entirely. We'll have to watch out and see how this develops before the tax becomes operational. I hope you found this video useful. If you'd like to talk about this subject or any other tax matter, please don't hesitate to reach out to me. Thank you.